The mid-year economic and fiscal outlook we released today confirms that the government's plan to restore the budget to balance remains on track. In MYEFO, once again, the budget is projected to return to balance in 2021. The underlying cash deficit is now expected to narrow from $36.5 billion, or around 2.1% of GDP in 2016-17, and that is down on the $37.1 billion in the budget and the pre-election fiscal outlook, or PFO, to $10 billion, or 0.5% of GDP in 2019-20. The average annual pace of fiscal consolidation is 0.5% of GDP over the forward estimates period, and that is consistent with previously reported trajectories. Since PFO, the total effective parameter and other variations has been to negatively impact the budget by $12.8 billion. This includes a $30.5 billion downward revision to revenue, driven principally by weaker wage and profits growth and weaker tax collections, offset by reduced payment estimates. Importantly, the net impact of policy decisions made by the government, including fully funding all election commitments, has been to improve the budget by $2.5 billion over the forward estimates, with net improvements of more than $2 billion in payment savings and just under net $500 million in increased revenues. In each and every year of the budget and the forward estimates, net policy decisions of the government have improved the budget bottom line, including net payment savings in each and every year. Once again, the government has demonstrated we do not spend more than we save, and that the predominant mechanism for restoring the budget to balance is by getting expenditure under control. By contrast, the net effect of Labor's policy decisions at the last election was to increase the deficit by $16.5 billion. This means that under Labor, this statement would have been at least $16.5 billion worse off today, and as much as $19 billion worse off when you take into account the improvements the government has made of some $2.5 billion on our net policy decisions. Despite the many global and domestic challenges we face in our economy, an accumulated deficit of $94.9 billion over the budget and forward estimates means Australia's fiscal outlook in this MYEFO is in a better position today than it was a year ago in last year's MYEFO, when it was $108.3 billion, and 3 years ago when it was $122.7 billion. Government payments will be $18.5 billion less than set out in the budget and PFO. In fact, payments in 2016-17 will be nominally less than projected in the 2013 PFO. Government payments as a share of GDP has been reduced from 25.8% of GDP for 16-17 in the budget to 25.2%, and is expected to remain stable over the forward estimates. Real growth in payments over the forward estimates has also reduced to 1.9% since PFO. Net debt is projected in MYEFO to peak lower at 19% of GDP and 1 year later in 2018-19, and then decline over the medium term to around 10%. Our debt remains less than a third of what the average of advanced economies are experiencing on both net and gross terms, and is less than all G7 economies. MYEFO also includes a revised estimate of the total value of budget repair measures legislated since the election at more than $22 billion. It also contains a revised estimate of the value of unlegislated budget repair measures at $13.2 billion, which includes $12.5 billion in payment savings. This means in just 6.5 weeks of sitting, the Parliament has legislated almost 2/3 of the government's budget repair measures. The ability to secure passage of budget repair measures has been a consistent issue raised by ratings agencies with reference to their assessment of our fiscal position. Now, there is more work to be done, as the Finance Minister and I know well enough, and the government is committed to continuing to work with partners for budget repair in the Parliament in next year's autumn sittings. Turning to the economic outlook, this remains positive, notwithstanding a downward revision to real GDP growth forecasts, partly due to the negative result in the September quarter national accounts. Real GDP growth is forecast to be 0.5 percentage point less at 2% in 16-17, and growth is then expected to pick up to 2.75% in 17-18 as the detraction from mining investment eases. Exports and household consumption are expected to support growth, with dwelling investment growth higher in the near term and a modest recovery expected in non-mining business investment over coming years. In terms of the nominal economy, there have been significant developments in commodity prices over recent months that have affected our forecasts for nominal GDP. The strength and volatility of commodity prices have presented a particular challenge in framing the forecasts and projections. Iron ore prices are around a third higher than they were at the budget, which I note was criticised at the time as being heroic, while metallurgical coal prices are roughly 3 times higher and thermal coal prices have almost doubled. Australia's terms of trade rose by 4.5% in September quarter, and following a rise of 2.3% in the June quarter. Now, extensive liaison with industry contacts by Treasury reveals substantial uncertainty around the drivers of the recent price movements and widespread expectation that current price levels will not be sustained and no clear view as to when they will fall. Accordingly, Treasury have adopted a more conservative approach and departed from the usual practice of adopting the 4-week moving average. Metallurgical coal prices are assumed to be $200 per tonne free on board, in line with recent quarterly contract prices, before declining through the September and December quarters of 2017 to $120 per tonne free on board in the March quarter of 2018. Iron ore prices have recently averaged $68 per tonne free on board and are assumed to decline from this level through the March and June quarters of 2017 to reach $55 per tonne US free on board in the September quarter of 2017. This is the average price that has prevailed since PFO. Now, thermal coal prices are assumed to remain at $62 per tonne free on board over the forecast period, and this is consistent with recent averages before the recent sharp price increases that we saw and the current Japanese fiscal year annual contract price. As a result of this, nominal GDP growth is now forecast to be 5.75% in 2016-17, but then moderate to 3.75% in 17-18. Nominal GDP growth has also been revised down in the projection years in 18-19 and 19-20 from 5% in each year to 4.25% and 4.5% respectively. Now, to support economic growth, the government will continue to implement our national plan for jobs and growth that I outlined in the budget. This plan is not only necessary to increase living standards for all Australians, but to underpin revenue growth for the Australian government by supporting increased earnings for employees, companies and their shareholders. This will support returning the budget to balance and to paying down debt thereafter. The medium-term projection for the underlying cash balance in MYEFO sets out a consistent trajectory to that reported in the previous budget, as I've already noted. Now, just in wrapping up, this statement supports a growth-friendly economic set of policies. And notwithstanding the reasons for optimism that exists, it reminds us of the need to clear any fog of unreality about the scale of the fiscal and economic challenges we face as a nation, and the need for partners in the Parliament to support government efforts to restore the budget to balance. When we look at particularly the issues of Australia's international standing on debt and our performance vis-à-vis other countries, with growth rates at 2%, at the top end of the scale for advanced and AAA rated economies, and an improving global outlook, as the statement sets out, and continuing of evidence that the Australian economy is successfully transitioning from the mining investment boom, there is reason to be positive and optimistic. It is not surprising that despite the deficit and debt legacy which was left to us by the previous government, that in the advances we've been able to make, we continue to stand strongly in international debt markets, and we continue to perform well in meeting our external financing commitments. This is evidenced by the success of our bond offerings, including our highly successful recent 30-year issuance and the performance of our Treasury bonds. Australia continues to be well supported and rated by international debt markets, reinforcing our global reputation and standing as a secure place to invest. So this statement provides a responsible, conservative and transparent update of Australia's government's fiscal position, an optimistic but very realistic outlook on our future economic performance.